Hello. Yeah, good afternoon, everyone. After lunch, tough panel to do, but I'm joined with very exciting guests, on the panel. So I'll maybe starting from my right and your left, maybe do very quick, 20-second intro so that everybody knows who they're speaking with, and then we'll kick off the proceedings.
Uh, Good afternoon, everyone. Thanks for having me over. This is Ankur Bansal here. I'm the co-founder of a credit business called Black Soil. We are a mid-market focused NBFC, and we also run credit funds. We've been doing it for last 10 years, and instead of deployment, I'll say we have collected over $1 billion in the last 10 years, and I think that is the beauty of a credit business.
Hello, good evening everyone. My name is Bhavdeep. I'm from Northern Arc Investment Managers, and we have been running a private credit franchise for the last 10 years now. Have kind of underwritten more than 16,500 crore of credit over the last 10, 11 years now, since 2014, 15. And we are we have launched so far 14 credit AIFs and debt PMS solutions. So that's what we do at Northern Arc Investment Managers.
Hi, I'm Monu Jain. I'm with Avishkar Capital. Avishkar, I don't know if you know, but we are the pioneers of impact investing in India. And, we work on the mantra of returns with resilience, so follow both. We do both equity and credit. We have multiple funds across. So I lead the credit strategies. And our credit fund is focused on supporting SMEs with sustainable practices and in global supply chains.
Hi, I'm Anand Shah, partner at AZB and Partners. I run the broader financing practice of the firm, so a lot of structured finance, a lot of private credit. Worked with, I think, apart from the credit funds over the last few years, I think banks, NBFCs, corporates, everyone alike on a lot of debt strategies. So good to be a part of the panel. Thank you.
Hi, I'm Vinod Murali with Ulterior Capital. I've been providing venture debt to Indian startups for about 18 years now, and Ulterior is a 9-year-old fund. We have more than 250 startup portfolio companies, and we are stage agnostic, sector agnostic. We like consumer, tech, healthcare, financial services. So good to be here today.
Excellent. My name is Madhur Singhal. I'm the CEO of Praxis Global Alliance. I've been working in private equity and private credit for 16 years now. And very honored to be hosting this panel. So I think maybe we kick off the proceedings, straight away. So we talk, the topic for the panel today is the missing middle, right? So we're not talking about, venture. We're not talking about large infrastructure and real estate investments. Really, what is the opportunity in SMEs and other emerging areas, for credit? And maybe Vinod, if we can start with you, where do you see this need for, SME and mid-market credit, if I can call it that? Where is the opportunity?
One word is massive. So I think even within the venture universe, there's a little bit of a difference now in approach. Over the last few years, given that there's been a bunch of listings, there is a keen focus on getting leaner, getting more efficient. So it's changing the way a lot of founders are thinking about business building. So it's no longer acceptable to raise equity capital, burn, and ask for more money. You had a few equity investors who were, a little bit more cowboyish in attitude earlier, which is not the case anymore. So it's not just the middle, it's the fat middle, as I call it, where even from the Series Bs onwards and larger bootstrap companies, the requirement is, it's not an equity story necessarily, and hence how do you replace and not just complement equity with debt and get a trajectory which is interwoven with the company's operating metrics. The good part, I would add again there, is the mindset of the founders or the promoters is moving more towards getting healthier and not just chasing a large outcome.
Monu, what would you sort of think about emerging areas or the types of credit? Like, where is the opportunity? What are the pockets of opportunity that are emerging and that you are seeing as attractive in building this whole missing middle and plugging this gap?
So I think private credit, performing credit in the missing middle is now well understood, well tapped. Yeah, earlier this year also we've already had like $1 billion of fundraise commitments announced, mostly performing credit, mostly targeting mid-market. But what most of the funds are doing is they're going upwards of 100 crore ticket size. It's easier because companies have established governance, they have credit histories, they have track records, same effort for a smaller ticket transaction than, but the opportunity set is so much larger in the 50 to 100 crore ticket size. It's a bit more difficult. Obviously, we as impact investors do what nobody else can do, or it's more difficult. So our thesis is centered around that. But what's happening now here is that the opportunity within this is also getting more nuanced, given what's happening in the world, the geopolitics, and how the AI surge has happened. So while India is not at the cutting edge of AI technology, and Amit also said earlier, we can't fund that as private credit, we can't. But what's happening is that India is become a credible destination for the digital infrastructure. For example, data centers. Now we have $65 billion of commitments made for setting up data centers in India. This is just in the last 1 year. What it does for SMEs is that you need energy, you need power, you need cooling systems, and it's trickling down to the SMEs because they're building precision engineering, you have HVACs, you have cables companies, you have UPS systems and system integrators. Similarly in semiconductors, India has seen a lot of support on a domestic front for manufacturing, even to support our own electronics industry. So a lot of capex is happening. And that capex in turn is getting down into these industrial gases, specialty chemicals, testing labs. Now these are the SME opportunities and pockets we are actually seeing on the ground, MEP subcontractors. And then energy, sorry, just one more point there, is that all this requires tons of energy. For every megawatt of computing power, you at least need 2 megawatts of energy. So with the kind of commitments that have been made, over the next 5 years, we're going to see 10 to 15 gigawatt of power requirement. So India, with its focus on renewables, is also, there is so much capex that's coming in that segment. So what we are now seeing as investors who are focusing in the less than 100 crore ticket size is that this opportunity is getting easier to tap because there is more visibility of cash flows. It's driven by well-funded capex, customer projects. There is predictability on how they will be delivering it, and on very back of the envelope, you could say this opportunity by itself could be another 40,000 crore to 60,000 crores over the next few years.
Ankur, from your vantage point, you've been financing companies of this nature, both on the traditional side as well as some of these new AI, digital infrastructure and so on. How does the credit opportunity and how do you as a private credit fund really differentiate, versus some of the traditional sources of capital? And why are banks and NBFCs not able to get it? It's just process and the way their constraints are, or is there something more to it?
So if I talk about the last part, so the last 18 months we have had a different experience. I'm going to contradict to yours. Today the biggest competition we are seeing in the mid-market space is with private banks. So what is happening is, I think they have also realized that there is only that much capex or that much NIMs they can make with AAA, AA rated companies. So you have to come down the curve to A or BBB plus clients or BBB. So in that segment, now we are seeing a lot of the private banks aggressively entering the segment. The difference is that requirement is much more than what a single bank may underwrite. So that's where players like us can come into the picture. Ultimately, this has a pressure on the yields and there's also a compression as such, but for an ecosystem it's great because everybody wants bank funding ultimately. And if you have a strong balance sheet, you can wait it out. So it's only when you have urgent capex, where is the gap, where is the situations like, private credit funds coming. If there's acquisition financing, again, private credit funds can come in. So our customization can be much more than what maybe a bank can do. So today, the concept of weighted average cost of debt is more relevant for some of these MSMEs, mid-market companies. And they may take some higher cost of debt from some of us here, but ultimately, long term, they are looking, the banks also start doing it. And if you see, RBI also went into the entire thing, allowing banks into acquisition financing. So how that plays out is something from a conceptual perspective, you can see this is going to happen. So market is growing overall because, as she mentioned, government is another big spender, because of which there's a huge order books being built up across the value chain. And many people want to come and have it, financing happen. Now, traditional guys are also upping the limit, and we are seeing that all kinds of capital requirements are open to. So we have some clients where they have taken business loans of 50 lakhs from 10 NBFCs. They may have cash credit also, but still they need more capital because they want to do more capex, because the business is also growing 30-40% year on year. So because equities may not be available, because every company is not an equity story from a VC or private equity perspective, but is a strong SME IPO story or a public market story. So that is sort of driving the sort of ultimate sort of direction for a lot of the companies that we are seeing who are working towards. But profitability is still the key, because if you want to obviously tap into banks, or at least the visibility of profitability is not far away. So that's what we've been sort of seeing as a market dynamics which are changing, at least the segment that we are operating in.
Well, actually, that's very right. And we talk about yields and the cost and the risk, and I'll get to that like literally after I hear perspectives from Bhavdeep also on where the opportunity is here. You see, one of the things that we've always seen, what banks are not able to do, and NBFCs are not able to do is, accept all kinds of collateral, put the right guardrails on the type of credit, flexibility in repayment terms, prepayment terms, the way they are able to structure and do combinations of equity and do some sort of the different shades of gray on structured credit. So this SME opportunity, from your perspective of what you're seeing in the market, what is therefore the differentiator for private credit funds like yourself?
Yeah, sure, Madhu. So I think the way I think I see it is that it kind of sits beautifully between the banking system, which kind of gives quite templatized asset-backed lending, and as they kind of say, no offense to any banker, but typically bank wants to kind of give money to those who don't need it, right? We are the ones who kind of want to give money to who need it and who we believe are able to kind of pay back to us. So I think it's a very, not a templatized way of lending or investing, but in a very risk measured way of kind of looking at investing. So kind of sits in very well between the banking system lending and the capital market fundraise, right? So, and I believe that there are certain opportunities, particularly two pockets. One is the, I think, the equity consolidation space. I think that where banks are really constrained in terms of giving lending. In that space, there are a lot of opportunities opening up for promoters. One shareholder wanting to buy another one, giving kind of exit to private equity before IPO and stuff like that. So I think that segment is something which is very attractive, and we see multiple opportunities in that segment across sectors, whether it's manufacturing, whether it's distribution, pharmaceuticals, logistics. So we have been evaluating certain opportunities, and this as a theme is something which is kind of we kind of find across multiple sectors. Another segment is, I think, what we discussed earlier is about this 50 to 100 crore segment. There are enough and more players, whether bankers or some of the other AMC-backed AIFs, which are in that space of larger ticket, investing or lending. I think this 50 to 100 crore segment is something which is very, very attractive, and that's where we are also focused on, because that's where the flexible capital is required, looking at the profile of the company and the profile of the promoters. So we believe that is quite a scalable proposition, and I mean, we all know that as much as cliched it might sound, but India is, I mean, there is no dearth of opportunities, but there definitely is a dearth of capital. So to the right set of people for the right business opportunities, I think we believe that there are a lot of structured credit opportunities in this missing SME.
No,
missing middle
it's
SME.
interesting, and Anand, I'll come to you. I think, what some of the panelists have already spoken about is you're competing with bank credit, the cost of funds and banks, and, and some of the NBFCs we know very well. So we're, as private credit, trying to get or manage yields, covering the risk, and also operating in the environment where cost of funds are what they are, right? And you are in a very unique position. You see it from the buyer side, seller side. Talk to us a bit about what you are seeing on yields and what you are seeing as measures and tips and tricks that funds are being able to use to balance this, to get rewarded for the risk they take in a fair manner while also competing successfully in the market.
So that's a good question, Madhur. I think fundamentally, where is it that our yields are coming from, right? The premium is really, from an Indian context, it's the enforcement premium. Because of the time taken, the effort taken at the time of enforcement, you're building in a certain premium. And that is really where the delta is lying between banks and the traditional funding and private credit. So if you look at it maybe even about 5 years back, right, a lot of it was pure hard asset-backed lending. You had personal guarantees, you have a pledge of shares, etc. But I think there you are getting a complete movement, in a sense, to cash flow based lending, right? And that's what a lot of panelists have spoken about through the day today, where I think a combination of factors has led to private credit looking at cash flow, the ability to take quicker decisions to basis the visibility that you have on cash flow, and that's really where you're able to generate that alpha in the yields ultimately. So therefore, I think at the end of it, right, the journey that we're looking at it as a country, if we are able to bring down that enforcement premium, right, with a lot of discipline which is coming into the market, that is really where the yields could potentially become better, but you're not basically mitigating the credit risk, but really the enforcement premium over there. So that's really what we would hope for.
Monu, I will bring this question, a little bit to you. You've seen credit, of with sort of larger businesses or more evolved, more mature businesses. How do you compare that risk-reward equation to the risk-reward equation that you to finance, here? And how do you still make yields work? Because the competition here is actually stronger. All of these guys have banking relationships. All of them have working capital lines, supply chain financing lines and whatnot. Talk to us, just compare the two worlds and how different they are. You've seen both.
Okay, so if you're referring to my banking career, so yeah, pretty much. And but I mean, yes, you're very right. In private credit, especially where we are operating, performing credit, the competition is increasing because everybody recognizes the opportunity. Many new funds have come out. But it's like any other market making, right? You have to create a product which is of value to the borrower. So, and that's where I think private credit's USP stands, is creating flexible solutions. So what my philosophy always has been, good company, tough transaction, if you need to get a structured credit out. Never a tough company, good transaction. No, okay? So every company will have a requirement which traditional sources are not going to pay. A bank has restrictions and BFC has restrictions what it can do. And which is where private credit opportunities, that's what we scout for, where what we give, they, instead of comparing it with a bank yield, they're literally comparing it with equity or the growth ROE that they are generating on the growth that they will get with that money. And we see those opportunities in a lot of ways. Just speaking very tactically from our experience is that company gets an order, and we see a lot because we are an export focused fund. There's an export order that's come. Banks are capped on collaterals. They've got the 1.5x, they're not able to give more, and they need to deliver on that. For them, the value of delivering that order in time is a lot more, and so the cost is not that material at that point, right? Or we see asset-light businesses, logistics, right? I mean, I'm not talking about asset owners in logistics, but so they're good businesses, they're cash flow businesses, but they're not able to get traditional bank funding. So they're happy to pay more just to get it. Or even, I've got very interesting cases of a pharma company, great capex, funded by banks, but they got a new product for which they need to go and develop the market overseas. Now, who's funding that? We fund cash flows. So as long as they have the ability to repay and create a great outcome for the company, that's what private credit will do.
Vinod, you've funded a lot of new age companies. And one of the 7-8 years back when we used to talk about private credit of this nature, the primary proposition used to be non-dilutive to the entrepreneur or the promoter, right? And I think we moved away from that, and we're actually giving credit for, sort of satisfying the need of credit. How have you seen repayment terms and other terms of giving this credit evolve, therefore? And how has the risk management changed?
Sure. Actually, just as a prelude to that,
Yeah.
extending Monu's point, if you have hard data, hard assets, strong reputation, easy access to credit. Now, within that is a spectrum. There's banks at the top end, and you have what I call traditional private credit, and you have a little bit more adventurous in my world, in some sense, right? So, when you don't have enough information, when you don't have enough of a track record, how do you build the asset class first? Then it's about the product and the outcomes, right? So that's the premise. So it takes time. That's the first part. What helps is focus, a fair bit of agility in underwriting, a fair bit of flexibility in some of the repayment terms and the architecture, but it equally has, it needs very, very rigorous monitoring and collections. So we have, for example, monthly payments. And when I say we, there's also another product that we tried for very young NBFCs or for working capital requirements. The rigor of monthly or very frequent payments is your answer to not having data upfront. That's one possibility. The second is when you have sufficient data to look through maybe 6 to 8 years and you've seen 2 to 3 microcycles, then you can say okay, there's a pattern emerging on the risk return arbitrage in some sense. But the core point remains that if you don't have, for example, Monu said, if somebody's done well in India, but they want to start a new business line in Vietnam, the only thing you know is they've done well in India. And you may or may not understand the Vietnam market, but you have to price this risk. So you start with a small slice and you grow with the company. That philosophy has worked well for us. So keeping a little bit of faith and comfort on the person, the people, the capability, but rolling the dice on performance, that's the balance in some sense.
Ankur, I'll speak to you a little bit about, how are LPs seeing this risk yield equation, right? And I'm not going to touch the topic of currency and forex and global investors. I keep that aside for the moment, not to hijack this discussion. But domestic investors, domestic LPs, where does private credit and specifically SME, driven private credit, where does it stack?
For LPs, I will put it maybe 2 buckets: institutional and non-institutional. Institutional bucket is something I think is still getting developed, right? We have still not reached a stage where private credit, alternates itself, we are at that stage first, getting alternates more and more comfortable for everyone being there, right? So we still interact with some insurance companies where they don't have a separate alternates team, or, the IC keeps changing, etc. I think there is still a little bit early days for some of the more insurance companies kind of structures. But those who do it, for them, they love it, right? Because once it's like, only the proof is in the pudding. So once you go through that experience, you actually delivered the returns that they were used to, and then you become used to it, because ultimately the kind of returns we're talking about here across the table, it's not easy to generate those consistent return on a cash flow basis, liquid basis for investors from the alternate space, on the credit, if you look at it. Because in private equity, we see you put the capital 5 years, 7 years, there is no cash flow coming from them. And some of them are okay with longer duration assets also, but this is very important to diversify, right? Because like one of my pitches for my earlier fund is like, Trump came, Trump went away, wars have happened, still the returns are still the same, right? So why would you not want uncorrelated returns? So there is enough of data that each fund manager present here can present from their own experience, that this strategy really is important to have. What percentage allocation comes down to ultimately what the person is trying to drive for. When it comes to family offices, again, there are like 2-3 different categories, right? There is one who really have done so many of those funds, they know exactly what to ask or what to go in diligence. Then those are others who do not care about risk, they only care about returns. And what is the most fancy thing today could be another fund where people may call A, but the returns threshold of the portfolio might be B. And only the portfolio performance will tell them what exactly is happening. And then there are founders, for example, who from the new economy world, it will not understand real estate credit. And then there are investors who only like real estate credit, they do not understand new economy. So it is a sort of a phase. Alternate itself is new, so obviously family offices, HNIs, wealth firms, everybody is going through that phase of understanding what fund managers are doing, how it is being run, and ultimately the comfort comes from the people you have within the fund. What is the skin in the game, etc. Now, the pitch can differ from manager to manager. Ultimately, to be honest, the returns is what drive the decisions for many of the investors that we have seen closely. Risk is not something that they really want to talk about, though obviously it's the fund manager's duty to explain what you're actually entering into. And ultimately, the wealth firms play an extremely active role in fundraising. So how they are positioning the product also plays a very key role in decision making.
Anand, you advise a lot of family offices also, right? And a lot of other institutional investors. What's your perspective from their lens? What are they worried about and what are they comfortable with?
So I think again, as Ankur put it, there are different family offices asking different types of questions, right? I think what they've learned during the journey has been different, and I think accordingly they phrase their questions. I think if you look at it, by and large, I think skin in the game, manager's skin in the game is an important one. I think by and large when we speak to people, that is something they would always check the box on. The other is, again, as you get a little more sophisticated questions around, your single borrower exposures, your group exposures, I think a little more sort of testing around those aspects. The other thing, I think, what a little more sophisticated ones will push for is what is contained ultimately and hard-coded in the PPM and the contribution agreement, right? Because that is not a deviation which can ever be accepted. That ultimately will be a breach of contract from their perspective. And that is where I think the more sophisticated ones will push for, which ultimately, if you look at it even from a regulatory lens, right? You have RBI now on the regulated entities, having brought in their regulations in relation to fund exposures. SEBI also moving, including co-investment, etc., the regulations that they are bringing in. So, in a sense, if you look at it, our regulators are also controlling or institutionalizing, in a sense, the manner in which your demand side and supply side is ultimately getting regulated. So I think it's a combination of factors across each of these.
Bhavdi, we've spoken a little bit about yields and risks, right? And 3 years back, we used to be very proud when you're talking about private credit, and especially the missing middle. We're talking about how GST returns are now available. A lot of digital exhaust is available to underwrite better credit to this segment that traditionally could not be underwritten. Interestingly, when I read this and assess what's going on, I get more worried now, because actually that's a blessing in disguise for banks, because all they really needed was this data and this endorsement and this track record. How do you navigate your risk frameworks to be 2 steps ahead of these traditional financing institutions and make sure that this flexibility we're talking about, yields we are talking about, differential credit with differential terms we're talking about, how do we sustain that? And how is the risk management framework changing to enable this?
Yeah, it's a very interesting question, and I think the availability and the quality of data obviously has kind of improved quite materially over the last few years, whether you call it proxy data or the alternative data also being available. I think that quality has improved. But it's pretty much like the debate between the quant-based investing versus fundamentals-based investing, right? So just the availability of data is not going to really help you alone, take a decision, right? So ultimately, it's just the interpretation of data, and how do you really look at the data, interpret and take a decision on investing. Like for example, we keep talking about this cash flow-based investing versus asset-backed investing. Now, for cash flow, you might have all the data available, but it's just about rather than just looking at the inflows and outflows. For example, look at as simple as the repeat customers, for example, the end of the balances and stuff like that. So how do you really look at that data is equally important. So of course, if you train AI with all the historical data availability, of course it can kind of help you facilitate the decision making. But to my mind, that alone is not going to change the risk appetite or of the templatized lending that is done by traditional bankers. That's certainly, because ultimately it's a matter of risk appetite, and that's where I think private credit people have a role to play rather than a template lending, right? So
It's interesting. Let me do a surprise rapid fire a little bit. So we'll start with you, Vinod. One underwriting mistake you have seen over the last 1 to 2 years. Same question for everybody, but we'll start with Vinod.
Biggest one is reading the founder wrong in our case. So I think a lot of impact, materiality of impact comes from that. In my view, or in my world at least, there's ability to recover from operational issues, execution issues, capital issues. But if you get the founder aspect wrong, by which I mean there's malified intent, or there is an implosion between founding teams, that is possibly the toughest risk to price. It can happen the day after you fund the company, and it can be irrecoverable from that point on. So I would say, and that is tough to call. So where the answer mitigant to that, since we also raise money, the mitigant is referencing to the extent you can. So understanding what drives a particular unit together, and just being good friends doesn't cut it. There's a lot of layering to that.
Anand.
So I think this is a field day for me if you ask this question. But if it's one, I think with data-driven sort of exercises now, I mean with GST data out there, fantastic piece of data. It tells you what, it doesn't tell you who. right? And therefore, effectively, I mean, one of the instances is circular invoicing, right? That's something that we do. I mean, that's not hypothetical. It happens fairly often. And that's something which I think we've seen a lot of mistakes, and then, of course, a lot of work that we as law firms need to do after that. So.
Very interesting. Monu?
So having worked in the SME and mid-market space for like decades now, I can clearly say that one underwriting mistake very common in that segment is relying on what's on paper. And so the market context is just so extremely important. Your ability to cross-check and triangulate with the suppliers, vendors, competitors, other lenders, and I think I have saved my institutions a lot of money by being in the market and going beyond the numbers that are available.
Bhavdeep?
Yeah, so I think Monu and Vinod, both of them kind of covered the same point. I think just relying only on what you see or the data, right? So I think the intent and the governance risk is the highest. So how do you really interpret that part and figure out story behind the story or the intent, execution capability of the promoter? I think that is the single most reason why one would have kind of lost money.
Ankur, anything different you have?
Yeah, I have. I have one specific instance where we took a call that a regulatory approval will come in, and that didn't come in. So there was
binary risk kind
there
of
was so it was a. It obviously sounds in hindsight more sort of we being over adventurous,
Yeah.
but it seemed pretty obvious it will come because the situation was such that the SHA was signed, capital was ready, we were at the last stage. It's a matter of time. But then India risk emerged, and that itself was a very expensive learning for us. So that I think puts in one bucket. There is another bucket I was thinking that that we have seen many times that we always also get sometimes overexcited. The concept bias of FOMO sometimes comes in, where you get, okay, everything is going right for this company. So how do you sort of keep your emotions aside and do your traditional fundamental underwriting? So I think whatever has been said here, you have to do everything. And every day you have to change, improve your underwriting. So it's a daily business. It's not like once in a quarter, you monitor once a month, but every day you learn from companies and from smart founders, like just Vinod just mentioned. We all have our own experiences. And that learning book needs to keep changing. So at the same time, be able to do business fast enough, and you cannot just take a step back from the business.
Got it. And one last set of questions before we open this up for a few minutes of questioning from the audience. Monu, we'll start from you and then sort of go in this hypothetical, anti-clockwise. What is really needed for a private credit platform for the missing middle to truly become large, scalable, big? It could be an internal thing, external thing, policy thing, whatever suits you. But what do you think is missing and what's really needed for this opportunity to truly explode?
So private credit fund by itself is supposed to be a 20 portfolio company fund, right? Like that's the whole idea, because you are providing bespoke solutions. The industry is scaling with the entry of multiple funds into that. But for the fund itself to spot the opportunities to get into the right segment, I think there is still lack of awareness amongst the ecosystem. Still needs a lot of strength. It's been growing, but we are still at less than 1% of the total credit in the industry. We are 0.6% of GDP compared to 3-4% of US. And so once that awareness sets in, I think that discovery of the right opportunities becomes a lot better. And in terms of internal processes, I think somebody else also mentioned, AI tools have made it a lot easier to now kind of generate your basic notes, and we triangulate with our market context and we put it together. So the processes have become fast, they are more efficient. But I think if one thing you were to ask me, I would say greater awareness about the category.
Bhavdeep?
Yeah, so I think private credit as an industry will remain in some way little bit of niche simply because at every point in time, for example, the few companies, 20, 25, 30 companies, whatever that we lend to today, if they are doing really well over the next 2, 3, 4 years time, while our expectation of return from the same companies will remain 15, 16%, but these companies would have kind of graduated, matured, and therefore their cost of capital could have come down, and therefore they might have the opening from either banks or capital markets to kind of raise their fund, right? So we'll always have to have that origination engine running so strong that we'll be remaining in that 15, 16% range and kind of keep doing it. Good news is that in terms of both demand and supply of credit, there is humongous opportunity in India, right? Because again, land of opportunity, lot of capital required, as long as there is an awareness not only on the LP side that returns can be made, but also on the SME side that if there is a decent credit worthiness and then the case for credit, then there are enough givers of credit also available in the market. And I think the kind of growth that we have seen in last 7 years, I think LPs, domestic LPs in particular, don't have too many options on the fixed income side but to come to private credit. What maybe few years was an opportunity to invest in debt, today is a need for them to kind of invest in private credit. Just look at last 7 years. We got CRISIL to do some work for us for one of the new funds, and they shared with us that in last 7 years the pooled IRR of the industry was 14.07%. So the kind of returns that it can generate, potentially risk adjusted, for the LP as a community, is much better compared to any other fixed income opportunity that is available. So I think awareness on both sides, credit side as well as supply side, or demand and supply side of credit, is going to be really useful and catalyst.
Ankur.
Yeah, sorry. So I totally agree with my peers here. I think awareness with LPs is very critical for this business to actually scale. And the LPs could be institutions or institutions, etc. And it's important to match the return risk threshold with the right fund partners that they're looking for. On the other side, as a business, I'm taking even Vinod in our same group like us. I call ourselves like a credit factory because we do like large volume with like 50 to 70 trades, maybe a year, maybe more than that. So we work like a factory. So as a factory, you need to have very strong process systems. And those process systems cannot function without tech as the backbone. And when I say tech, I'm not saying AI, I'm just saying pure tech. So that start to end, can you from the moment the lead is logged in till your last EMI, how much you can use that to be able to make your process more efficient. And at the same time, invest a lot on monitoring side, because you already are doing on a dashboard side a lot of things, to be able to use the data, because private market is about private data. So yesterday somebody asked me, how do you get these insights? Insights are coming from daily basis because you're interacting with companies, you're interacting with the portfolio companies, with companies you're not investing. So much valuable data is coming your way. How do you use it to underwrite? And typically, because when you meet a founder or a promoter, they will always going to say rosy things, right? So especially before they want to take the money. So you have to be very careful whether data and what they're saying is making sense. So if you have similar companies in a certain cohort, you can compare and see what the performance is. So data becomes important, but how do you use the data and how much quickly it's available on your fingertips becomes also critical and needs to keep updating on a monthly, quarterly basis.
Vinod, anything you'll add?
Going forth is not easy on this question.
Yeah.
I would say focus and transparency. So if you have to underwrite to a food business, a precision engineering business, a jewelry business, and a paints business on the same day, it's not easy, right? So you have to pick your lanes. I think getting to a level 3 level of detail for certain kinds of industries where the pattern recognition gets easy, that's the focus, and that will be a surrogate for success in my view. The second, actually, is the point made earlier, the LP communication, the transparency, the education. In fact, goes to your earlier question, what do LPs hate most? It's actually not bad returns, it's surprises. So they just don't be surprised. So if you've done what you said you would do and things have been outside your control, actually we found that people are a lot more forgiving. But if you've actually delivered on returns, but you've done something you're not supposed to do, they actually don't invest again. So avoiding surprises means keep communicating about what is not going to plan, where are your problem children, what are your ways out, maybe you don't have a way out. And we've said that in some of our updates, in these situations actually we kind of done and we can't do more with this. And that's actually been recognized, saying we call it out. They worry more if you don't say anything. So focus and transparency.
Anand, I know tough spot, but you're also in a unique position. You're at the top of the mountain seeing everything.
No, I think it's obvious from my end. It's ultimately, as I see it, if you are if you're really fixing the problem for the genuine missing middle, it's, I think, to achieve scale, in addition to the processes, in addition to the origination and focus on origination, I think the key from my perspective is legal engineering, right? Because I think what you really need to do is standardize your documents, your security packages, your package of governance, etc. Again, all of that may not apply apples to apples in all the situations, but at least to the extent you can standardize it across, I think that will help scale, because once you, it's impossible really to sit and negotiate every piece like what you would do in a sort of a large ticket deal. It's not going to be possible. So that's the way I would look at scale.
Excellent. I think we're running about time, but maybe one or two questions maybe we can squeeze in from the audience if there are. But our hearts will not be broken and ego will not be bruised if there are no questions. Like it's okay.
Yeah,
You
sure.
got a client, it looks like. Anyway.
Sorry, I'm taking that, but yeah. No, I think it's ultimately about standardizing your document package. You don't need to sort of renegotiate everything. You can do that in little more bespoke deals, but when you're financing the missing middle, it's about a standardized set of documents that you use. Of course, recognizing that this is private credit, this is not bank lending or NBFC lending. And therefore, how do you tweak your covenants, right? So I think by and large, depending on either it's sector-based or it's a sort of risk-based, right? Are you looking at it from a cash flow perspective? Are you really looking at it from a collateral perspective? Basis that, what are the variations in documents that you have ready at your end, so that once you send the document from a borrower standpoint, ultimately they want to close in 2 weeks and 3 weeks. So you don't need that back and forth ultimately.
In fact, just to add to Anand's point, and because we are also working in SMEs and speed is of essence, so we're also working on standardizing the documents which are general covenants, right? With an addendum on all the specific covenants, which will be specific to which industry, what cash flows, what financial governance you may be looking, what security, all of that. So that the customization is on lesser number of documents, or just like the basic thing. So there's a master and there's an addendum, and that works well.
Or hire AZB as counsel.
Yeah. Okay, so I will, she being there and looking at me is a clear signal. So with that note, thank you so much everybody for making this panel so exciting, and thank you to the very patient audience. We'll bring this to a close, but some of us will be outside if there are more questions. But thank you so much. Yeah.